2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated. For the time being, we're well positioned to wait for greater. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. Thank you, Mr. Chairman, for taking my question. a lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out, and also when they do settle out, what will be the implications for the economy, for growth and for employment. I think it's too early to know that. So, ultimately, we think our policy rate is in a good place to stay as we wait further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, sound long-term process before you come to the committee act
and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Chair Powell, there's naturally a lot of confusion around 2021 and supply shocks. Energy costs are down, housing imbalances look nothing like they did 4 years ago. Labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now, it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses, or market participants, or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
Donnell. Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, I mean, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low fours for more than a year. We've had inflation coming down and now in the mid to low twos. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. We might see a delay in that. I think in our thinking we would never do anything but achieving those goals. But we would, at least for the next, let's say year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019 we did cut 3 times. But situation was weakening economy. You had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation far above target now, and we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned it, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balance and judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment would be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. We're not in this situation, but the situation is that two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very long time. So again, difficult judgment to make. Not one that we face today, and we may never face it. But we have to be keeping it in our thinking now.
Thank you.
Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said solid, but we saw at the same time we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
It's going to depend. I think you have to just take a step back and realize this is why we are where we are. We're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't. And we just don't know until we know more about how this is going to settle out and what the economic implications are for employment and for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They really have. They're not in the data yet. That tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what you.
I think we've got enough of oil, and it's definitely going to be going on for some more minutes, maybe 30 more minutes or so. Usually, sometimes it's within 30 minutes an hour, and then it should be done with the quick questions and everything. So maybe a couple more minutes, and then power is going to be done. But let's get back to what I'm looking at in the market, what I'm expecting, and what I'm looking at. So first of all, looking at Bitcoin. I usually give like a full detailed overview of what I'm expecting for Bitcoin and the crypto market for the whole month. I make a post on X, and I also create an exclusive PDF, which is just for those in the Bull Run group. So actually the post you get to see me post on X is something I copy out from the PDF, which I share with those in the Bull Run group. I decided to just copy an excerpt and post in there. So, but try while I'm compiling the content for this month. It's taking me quite a lot of time because I'm a bit distracted. So I'm a bit distracted and engaged with a lot of things this period. So not like I had time to like put everything together. And the more I delay, the more I think a lot of people are going to miss out on what could be my projections, right? And so what have I been projecting? So, but if you are on the Forex Trading Network, and I think even if you stay on the Bull Run group, I know I dropped a chart. I dropped my chart like weeks, I think at the start of the week or so. So I think anybody who had followed my charts on the Bull Run group or on the Forex Trading Network would have been able to have a perspective of what we've been expecting. Like, because I know I dropped a chart, an overview of what I was expecting, like my entry, because I know I was in the buy. I dropped a chart about the buy, which I'm going to share. That's the same chart, which is I already posted this since early this week. I think Let me look for it in the groups on Telegram a bit first, and then we can then take it from there. So I'm trying to. Today's date is May 7th, right? So this is what I was looking out for. I'll have to see how I can share the screen for this. How do I do this now? Okay. So share screen. Okay. So I want to assume that okay, this is the bull run distance. So I think I posted this somewhere around May 5th. That was 2 days ago. What I was expecting. So I have my strategy, which is called the Shifunomics Waves pattern, which I use, and I think I developed this strategy like 2-3 years ago. So it's called the Shifunomics Waves channel pattern actually. So SWCP, Shifunomics Wave channel pattern, which I've been using effortlessly very well on Bitcoin, and I used it on a couple of other assets too, a couple altcoins, and I've used it for gold as well. Use it for basically asymmetrical assets. And if you look here, I wrote about what we're looking out for is the 6th wave, which was the last week's pump. And then the 7th, which is going to be a breakout, was the supposed dump, which has happened. So after that, what is next? A buy to clear the CME gap above, which is going to get to the 96,893 levels there, and a sell to clear the CME gap below, which is going to give us a possible potential butterfly harmonics pattern being formed. And this is a 10-10 formation that is actually making me happy. So I'm just like reading it out for you based on it. And I think I posted the same thing on the Forex trading network as well. It's insane that I don't even know which of this is it again. Okay, I think I forwarded the same thing to the Forex trading network. So I'm just like reading it to be sure of what I said initially, and then we can pick it up from there. Okay, so how do I share the screen now? I'll have to share window. So this is I made this tweet very early today because this is like what I'm expecting, what I'm projecting, and I just did a repost of the same thing here about what I'm looking out for gold, what I'm looking out for BTC as well. And so I'm looking out from today, which is the 7th to 12th. So we've got like 7th coming. So let me make it this way. We've got like 7, 8, 9, 10, 11, 12. So for the next 6 days, I expect the market to be bearish for the next 6 days. So it's going to be a very interesting bearish ride going downwards. And the crazy thing is, I actually expect Ethereum to even be way more bearish than Bitcoin. So I'm going to share the charts, and then we're going to look at what I'm expecting. Let's look at Ethereum first of all. So of course, whatever is happening right now, with whatever speech power is making, is definitely going to impact the market. It can make it could be a bit bullish for a while, make it a bit bearish. But overall, I actually expect the market. That is just my own expectation, what I'm looking at. And so this is Ethereum. Let me see if I can. Make this a bit bigger. So this is what I'm looking at for Ethereum. I'm looking out for Ethereum to really like find its way downwards. Like this Ethereum chart. If you look at what we're looking at, if you can recall the last time I posted something about Ethereum on my X. I don't know if I could sort it out, but let me see if I can find a way to search it. Coming. I don't think that. Okay. If I check from the highlights, I should be able to see it. So let me share the highlights tab. I had something about Ethereum, but for some reasons I can't find it. I have to check for it very briefly. There's nowhere it's got to be. Okay. Fantastic. Now I think if I reload this, it's definitely supposed to just show up. Okay. I'll take this off. I just clicked on the exact post now, so if it loads up, I should be able to share that part of the screen. Fantastic. So this is what we're looking at in April for Ethereum, right? We're looking at Ethereum getting our target was 1750 to 1880 for Ethereum, and so let's look how well we got that. So yeah, if you look at the screen, we got to 1750 on Ethereum from as low as this. Let me highlight the 4-hour chart. From as low as this point at this level, we've got Ethereum went as high as here, 1750. Our first target was hit, and our second target of about almost 1880, the area of the zone where 1880 is. But now we're expecting it to go back down, right? And I expect it to go as low as 1540. I'm expecting a very, very interesting pattern to form here, more like a harmonics. So like this is the X, this is the A, this should be the B, right? And so if this is the C, then you want to expect the D, it should be around here, anywhere around there. So this is going to be like a very sweet buy opportunity for, I don't know why this stuff is showing like this, but let me make it work. But this is where I would want to like maybe look at getting in on Ethereum if I want to. Probably this is because if I'm looking at 7 to share this tab instead. Sorry. Okay, so this is the tab is looking at for. So if I'm looking at guessing buying into Ethereum, getting Ethereum, I should be looking at doing that sometime around next week. So the next, let's say if we get the bearishness I'm expecting, if we actually see it play out and continue, as I'm expecting. We could literally see the see it making new lows and getting to this point. I mean, from this level here, if I'm from here, this zone down to here, that's gonna be like a really long journey for it. Because I mean, if I'm looking at Bitcoin, the journey may not be really much for it. So this is my chart on Bitcoin, right? So this was the breakout. I was able to predict the breakout based on the Shifunomics wave channel pattern, which is what played out here, and we've got this breakout. And the same Shifunomics, this is the bullish aspect of it, and this is like from the daily time frame, and then this one I think was drawn from like 1 hour, so 1 hour 4 hours time frame, but it's a bearish Shifunomics wave channel pattern. So if this holds and continues going down to like 90k, if you look here, I was using like 99,000 as my stop from this particular projection. And the truth is, if you look at it from here to here, it's like a very poor RR, something like 153. But when you look at it's an average RR, not like poor, it's an okay RR. But when you look at Ethereum, it gives like way more RR than this, because it has like a smaller stop loss, a smaller amount of risks as well. So whatever Jerome Powell is saying in the market is definitely going to affect it. It could turn it out to get a little bit bullish and stuff, but overall, this is just my bias and basically what I want to see. And because of that, it's going to be interesting for us, because we could literally get to see Ripple is going to get below $2 again, right? Initially, so there's like an arithmetic calculation that if you use it for what we call head and shoulders pattern, you could get a projection of how high when there's a head and shoulder strategy being coming into play, another as well. And we could actually see that this could get to like $3. But another way, there are literally two major strategies in trading a very clear head and shoulder pattern, and one of them is the first one helps you to project the target of where you're going. The second one shows you a target for entry. And if we're looking at a target for entry, I think this is not going to be this isn't surprising. Let me put it that way. If you look from here to here, we've got like very interesting. So I won't be surprised if like I see price came to below $2, so like 1.93, 1.92 areas or so. So it all depends on how easy it continues getting bad. But overall, I don't think anybody should be expecting BTC to start rallying. I mean, yesterday was just a trap, right? Yesterday was just a trap. And I know I posted about the charts some 3 days earlier, which I showed earlier initially on the video. So I was on the buy, and then I go out of the buy and stuff and all that as well. And I think the only thing is several altcoins are going to be very, very, should I say, independent. Some altcoins are going to be coming down, some are going to be going up. So I'm a bit sketchy for altcoins, but I just like let my focus be on some of the main coins, right? My focus on some of the main coins is going to be good. Then you look at some coins that really sell hard, right? There's some coins that you see that are dumping very hard when BTC is dumping. I think you could get reciprocated trade opportunities in those kind of assets and this kind of plays. But overall, I don't really like I'm not sure I've got like any in mind currently. I would say I want to take on, because I mean, if you also look at memes, let us go to the daily time frame. So this is PEEP that we plotted from a very long time ago. This was the exact entry it got on PEEP, and it came down, another entry. And if you look at it's like even showing signs of bullishness. So I think trying to hunt memes, should I say altcoins, one has to be extremely careful, So that's why I just choose to just prefer staying on BTC, Ethereum, and memes will just do what they want to do. That's just the truth. They're just going to do what they want to do, and then obviously whatever is happening right now for in the market generally, with whatever speech Powell is making, is definitely going to impact the dollar, and its impact will be visible in trades, asset classes, and what have you, a lot of them. But in summary, whatever Trump Powell is in between. There's a lot of story in his speech, and if you look at what a lot of traders are looking out for this period, a lot of traders are not really concerned about. A lot of traders are not concerned about just the FOMC rate, because it was literally priced in before the time. But a lot of traders are super concerned about the speech which is ongoing currently of what Powell said. And if you listen to the few things he said, he sounds very in between, trying to find the balance. I think this is one of the most diplomatic speeches I've ever heard from Powell talk about. But a lot of uncertainty in the economy, some with the tariff and stuff. I feel like within the next 24 to 48 hours, we're going to get some devastating news in the world, and this news could be as regards the trade wars and tariffs. This could also be as regards wars and some battles between Pakistan and a couple of these other countries, or maybe any other country. But I feel like within the next 48 hours, there will be some negative news as well, which will directly impact the markets. I think it's going to impact crypto, it's going to impact the forex market as well. And so the uncertainty is still going to be there. It's not going anywhere like immediately. And I don't want to carry it away. I feel the cushion of we getting an entry for. So we're looking at this level. That's what I'm looking at from today, the 7th to like the 12th. So tomorrow I'm going to like go live. Maybe I'll go live around maybe in the morning time, or maybe around this time. Whenever I've got time, I'm going to come live. I'm just going to like share. I think because Powell is speaking right now, I don't want to show anything on the forex market, anything as regards that. I just want to just stay on crypto. Maybe tomorrow I'm going to like share something as regards that. And because I think crypto is a very bit on the more safer side for us. Until Powell's speech is done and the market's going to have like a reset, and then tomorrow everything is going to like begin a journey, and then most people are going to trade after his speech is done. So by tomorrow we're going to like look into a lot of asset classes and a lot of things, and I'm going to share a lot more charts and projections as well. But for now, we're just staying on what I'm expecting from today, the 7th to the 12th. And my targets for Ethereum is we're looking at the 1540, and then my targets for Bitcoin, I'm looking at 90k, and maybe anywhere between today and the 12th, we could land in those areas. That is what I'm expecting. And so that means the market is going to be bearish. Like I said, for altcoins, one has to be extremely careful, because there may be some alts that may turn out to be very positive, and there may be some orders. So alts are going to be, should I say, disconnected from the full bearishness of BTC and Ethereum. So I'm going to go up, so I'm going to come down. So you want to be careful which one you choose to pick. But if I see a very good altcoin tonight, tomorrow I'm going to like share. But personally, I'm playing it on the safer side with just the Bitcoin, the Ethereum, and then I'm trying to gamble around alt. I think alt will be very sweet from next week. And I mean, this trading, like I said, I'm going to be going live every day. We're going to look at the chart, what's happening right now, where we're at, and we're going to look at more entries from tomorrow. And let's see how the journey of the next 7 days is going to be for us. Bye for now, everyone. And I'm wishing us a very, very sweet markets after this. Bye, guys.